Good morning, friends. Today we are going to see the method in which tax is being collected by the government under the Income Tax Act. See, you would be surprised with the kind of tax collection which government makes through direct taxes, and majority of the direct tax comes through income tax law. The government earns approximately 12 lakh crores, more than 12 lakh crores through direct taxes. And out of this 12 lakh crores, friends, a lot of it comes through the Income Tax Act. Now imagine a situation if everybody starts paying income tax at one particular point in time. So let's assume along with return, everybody is paying the entire amount of tax. What would happen? Government would not get regular income. What would government get is a lump sum payment at the end of after the end of the year. Because that is what we have seen. The income of the financial year is going to be taxed in the assessment year. So if it is going to be taxed in the assessment year, and if you collect it after the end of the financial year, you'll get everything in a lump sum, and for some time government would be left with no revenue. In order to, expedite the collection of tax, there are provisions relating to TDS, TCS, and payment of advance tax. So basically, the entire intent is to get regular payment. Not only that, not only government collects the amount in advance using the provisions for tax deduction at source, what it also does is, it also keeps a tap on tax evasion. So tax evasion is going to be reduced because tax is collected or deducted at source. So you are deducting the tax, you are keeping a tap on the source in respect of payments made by any person to another person. So basically what it does is it keeps a tap. It reduces tax evasion. Not only that, at the source of it, there is some tax collection that goes in and the government earns some revenue during the continuance of the year. What happens is when you look at the earnings, when we earn something, we have a tendency to spend. So if we get the entire amount, what we do is we spend it entirely, and then at the time of payment of tax you would be left with no resources. So when tax collection or tax deduction is done at source, it is collection for the government at the very source, at the very the beginning of the revenue. So what you take home is the net revenue. As a income earner, you will take home the net revenue, and what the government gets is some amount of tax at the very inception. So this threshold collection has proved to be very robust, and what government has done is gradually they have increased the tax net as far as the TDS TCS provisions are concerned. In Indian scenario, it led to a lot of anti-tax evasion measure. Each provision under the TDS leads to lesser of tax evasion. I'll just share as we proceed further how it has curtailed tax evasion in the Indian scenario. And world over, friends, world over, every government, every country has got the TDS provisions. It is not just unique to India. However, in case of Indian scenario, it has led to mitigation of the tax evasion. As far as if you look at the developed countries, even the developed countries have got TDS provisions. In the US, they call it as withholding tax. As far as our syllabus is concerned, we do have a lot of TDS, TCS related provision. The TDS provisions are restricted to resident assessee in our case. So those provisions which are not related to resident are not covered under your syllabus. So we'll stick to what is what is taken up by your syllabus, and we'll try and complete each of it having regards to the practicability of each of the TDS provision. Let's take up, where the power emanates from. How does the government gets the power for collection of tax at source, or for deduction of tax at source, or for compelling an assessee to make a payment of advance tax? The power emanates from Section 4 of the Act. Section 4 of the Act is the charging section, and it not only levies a charge on the total income of the assessee, but it also gives power to the government to collect, deduct tax, or in advance. Either the government would ask the payee to deduct the tax, the payer would deduct it, or he would collect the tax, or the assessee himself would pay in advance voluntarily. So the power emanates from Section 4. Let's move to Section 190, therefore, which has got the power from Section 4. The total income of the assessee is taxable in the relevant assessment year. We have already discussed this. So if at all everybody decides to pay in the assessment year, the government would have no regular source of income. And therefore, we've got three modes of recovery here. So one is TDS, the second is TCS, and the third is advance tax. And there is one more mode of recovery that is covered by Section 192(1)(a) in respect of non-monetary perquisites on which tax is paid by the employer. We'll come to it in a short while. Now, this TDS or TCS, or the advance tax that is collected or deducted, or paid in advance, you get a full credit of all the amounts, all these amounts which are paid in advance by the assessee in the return of income. So out of the total tax payable, finally you work out the total tax payable. Out of the total tax payable, what you get is a credit for whatever you have paid in advance. Fair enough. Now what happens if there is a onus on the payer of the income to deduct the amount of tax and he doesn't deduct it? Can the assessee claim, okay, I was not supposed to, the payer was supposed to deduct it, I was not supposed to pay it, and therefore since payer has not deducted, I'm not at fault, I'm not going to pay any further. So basically, therefore, to again plug this kind of a situation, Section 191 is added, and Section 191 says that nothing doing, even if the payer has not deducted or collected tax, it is your responsibility, the income earner's responsibility to pay tax directly. So the ultimate onus is on the assessee who earns income, irrespective of the fact whether the payer has deducted tax or whether he is not deducted tax. But then that does not exonerate the payer also. If the onus is on the payer to deduct tax, he should deduct it. If he doesn't deduct, he is treated as an assessee in default. So even, the government can proceed and ask the payer to pay the tax. It does not mitigate the liability of the assessee himself, but then the payer cannot also go without deduction of the tax. So here basically, again, how it helps in tax evasion, is how it is an anti-tax evasion measure. What happens is it becomes interdependent. So the payer who makes the payment of income, he would necessarily deduct the amount of TDS, right? He would necessarily deduct the tax at the time of making payment to the payee. So when he does that, he has got no self-interest. He will not leave the deduction just for the sake of it, because if he doesn't deduct, he'll be treated as an assessee in default. So therefore, he would always deduct the tax, because it would then become his personal loss. If he doesn't deduct it, he would be treated as assessee in default and it would be his personal loss. And therefore, a balancing mechanism is created where the payer has also got a liability to pay the amount of tax deduction at source or the collection at source. As far as the advance tax liability is concerned, it is entirely of the assessee. So moving ahead, so the point here is that even the assessee is required to pay the tax directly, even though TDS or TCS provisions have not been complied by the payer. Let's move to the first set of tax deduction at source, and the first set is section 192. Now section 192 provides for deduction of tax out of income which is taxable under the head of salaries. Right, so whatever is taxable under the head salaries would fall under section 192. Any income covered by section 15 and the series of section 15, 16 and 17, everything got to be computed using those sections, and whatever income, so it is the income chargeable under the head salaries on which deduction of tax would be made by the person responsible for paying salaries. Now, who is responsible for paying salary? While we dealt with salary, we saw that any income that arises because of the employer and employee relationship, would alone be taxable under the head of salaries. Right? Do you get it? It is the employer and employee relationship which alone makes it an income, an item of income to be taxed as salaries. Now, if at all any payment is made without employer-employee relationship, section 192 would not come in play. So first and the foremost, you need to figure out who is going to be a deductor. Under all the TDS provisions, the first and the foremost thing, you got to find out who is the deductor. Now, deductor is one, in case of section 192, one who pays salary. Now, who pays salary? It is the employer. Right. So usually it's the employer who is paying salary, and employer would deduct tax at source from the payments that he made to the employee. Right. Do you agree with this? So employee would become the deductee. We call it as deductee, or at times you call him as payer, and employee as the payee. Because look at this. It is only at the time of making payment, right? It is only at the time of making payment that tax would be deducted at source. In certain sections, although even an act of crediting to the account of the payee would also, give rise to the tax deduction at source, the liability to make a TDS. However, generally it is at the time of making payment. Now, whenever an employer pays to the employee any amount which is taxable under the head of salaries, he'll deduct income tax. Now, at what rate? So the next question is, at what rate? Let us understand TDS in its raw form. When I make a payment of income to any other person, let's say 1 lakh rupees, and out of that, what I deduct is 10,000 rupees at the rate of 10%. The payee would take home 90,000 rupees, right? So his net income, his net payment is 90,000 rupees. What is his income? His income is entire 1 lakh rupees, out of which TDS have been made at the rate of 10% of rupees 10,000. So this rate again would become important. So first and the foremost thing, you've got to decide who's the deductor. The second is who's the deductee. And the third is at what rate tax has to be deducted. So in case of salaries, there is an employer and employee relationship. As far as salaries is concerned, you all will appreciate that there are very little deductions as far as salary is concerned. Number one. Number two, employer is entirely aware of what income he is giving to the employee. And therefore, section 192 stands out of the entire lot of TDS provisions. What it says is, you have to deduct the entire tax, whichever is payable by the employee under the head of salary. So, as if salary is your income, whatever tax is payable by the employee would have to be deducted by the employer and paid to the government. So, there is no fixed rate here. So if an employee, is earning 5 lakh rupees of salary a year, up to 5 lakh rupees, there would be no tax. And since there is no tax, you have got a rebate under section 87A. Since there is no tax payable by the employee, nothing would be deducted at source. However, if that if the salary is more, let's assume if the total income, the total salary paid by the employer to the employee is 10 lakh rupees, and the tax is, let's assume 1,12,500, you know, you as an employer, you will have to deduct 1,12,500 plus the education cess, plus the surcharge if applicable. So he'll have to deduct the entire amount of tax during the continuance of the year out of the salaries that the employer pays to the employee. Now, this income from salary would be known at the end of the year. Because the employee would do some tax saving, as we saw in case of Chapter 6A deduction. He'll do some tax saving. He could bring in some other losses under the head of house property. He can communicate to the employer, boss, I have paid interest on home loan and which is deductible out of my income. So at the end of the year, the employer would know the actual amount of salary paid, taxable under the Act. And therefore, what the Act has provided for is that the employer should deduct tax at average rate of income tax. Now, what is average rate of income tax? Average rate of income tax is the estimated tax payable. So, on 10 lakh rupees, let's assume, 1,12,500 is the tax payable. Excluding education cess, you got to add it up to find out the average rate of tax. But let's move like this. So, 1,12,500 divided by the estimated income. Because see, average rate of tax got to be computed at the start of the year, and therefore it would be based on my estimated total income. Very logical, friends. Since you have to make an estimate, there would be some here and there, right? Either it would be more of income or lesser of income. In case if it is more of income, you can make an adjustment. As an employer, he can adjust the average rate of tax at a later point also. But then, how do you compute the average rate of tax? It is 1,12,500 divided by 10 lakh. So approximately, 11.25% would be my average rate of tax in case of an employee who earns 10 lakh rupees of salary, taxable salary. So we are going to deduct as an employer, we are going to deduct at average rate of income tax, based on the estimated total income. I told you, I did explain you the logic why estimated total income, because you have to decide the average rate of tax at the beginning of the year. You have to pay every month. Salary is paid every month to the employee. Every month, whenever you are making a payment of salary, you have to deduct tax at the average rate. So that is provided. So fair enough, employer making payment to employee, he has to deduct tax at the average rate. Now this average rate would be distinct for each of the employee, and since employer is in a position to control the employee, he would be in a position to also figure out the average rate of tax. So not a big deal. The employers, it is not a onus on the employer. It is not too onerous on the employer to deduct tax at the average rate, because he is aware of all the income that he is paying to the employee. What happens in the process? Just because of Section 192, government earns a lot of revenue during the continuation of the year. So they are earning the entire tax. They are taking the entire tax on salaries in advance, right? So at least the businessman could pay in the subsequent year, but when it comes down to salaried employee, they end up paying everything in advance, because the employer has deducted the entire amount of tax payable by an employee and remitted it to the government. Now what happens sometimes, we'll come to the next concept, 192 1A. Sometimes employer pays salary to the employee, and what employer does is he also gives certain non-monetary perquisites. Non-monetary perks are those which are in-kind benefit which is given to the employee, and now the employee says, I do not wish to, I am not going to pay tax on these perks. Those are in-kind benefits, right? So the employer decides that he is going to pay it. Now if the employer pays tax on such non-monetary perquisite, it is exempt under Section 1010cc of the Act in the hands of the employee. See, it was the liability of the employee to pay tax. So ideally, it becomes perquisite. But then, just because of 1010cc, it is exempt in the hands of the employee. So since it is exempt in the hands of employee, no deduction is provided to the employer under section 40A V of the Act. You have already seen this. 40A V specifically says any non-monetary perquisite paid by the employer would not be deductible out of his business income. Now what happens is, here the employee is not liable to pay tax on non-monetary perquisite. It is the employer who is liable. Right? Now who is going to pay tax? It is the employer, and therefore duty is cast upon the employer to deduct the tax on all payments except for the non-monetary perquisite, wherever tax on non-monetary perquisite is borne by the employer. Right? So he'll deduct tax on all the payments excluding the non-monetary perquisite, and he himself out of his own pocket, pay the tax on non-monetary perquisite, as if it was payable by the employee. So as if it was payable by the employee, it is the employer's duty to pay tax onto the non-monetary perquisite every month on a monthly basis. Then, so in case where an assessee has got simultaneous jobs, it could happen, one employee is working with two employers. In that case also, what he can do is he can furnish his details of one employer, of salary that he draws from one employer to another employer. And if he so furnishes it to the another employer, it is the another employer's duty to deduct tax. Tax would be deducted by the current employer. So sometimes, either he switches from one employer to the other employer, or he simultaneously is employed by more than one employer. In that case, he could request either of them to deduct tax on the remaining amount of the other employer. Then, in case of employees who are working with government companies, cooperative societies, etc., and they get a relief under section 89(1) on arrears of salary. We have discussed this specifically with our lecture, probably on the best of my recollection, it was capital gains when we discussed it. So basically, what happens with section 89(1) relief is an employee gets relief for arrears that he has received during the year. Now, if that relief is allowable, the employer would deduct tax only after giving the benefit of that relief. Right? So 89(1) would be deducted out of the total tax payable, and only after that, whatever is left is going to be subjected to tax deduction. Then, so basically, see, the point here is that the employer is going to deduct the entire amount of tax payable by the employee on the amount which is taxable under the head salaries. What the employer is supposed to do, what he could do, if at all the employee furnishes all the details, it is only, optional for the employer. He can go ahead and deduct the entire amount of tax, but then if the employee furnishes all the details in prescribed form, there is one form prescribed, and that is form 12BB. I'll just show that form to you so that you practically know what the form, how the form looks like and what information an employee is required to fill. Now, what if the employee provides all the information to the employer regarding the tax savings that he has done, regarding the other income that he has earned? So if he is providing such information to the employer can give the benefit of those tax savings and also bring to the deduction other income of the employee. Let's take it by way of an example. See, this income under the head of salaries was 10 lakhs. So I told you that deduction got to be 1,12,500, right? Plus the education cess. But then the employee furnishes some more details to the employer, and he says that, well, I have paid a home loan interest of rupees 2 lakhs. Now, since he has paid home loan interest of 2 lakhs, what he'll have to do is he'll have to give a proof of payment of 2 lakh rupees as home loan interest. So what he does is he takes a certificate from a bank and deposits it with the employer. If he does that, that loss would be, available as deduction, and the employer would deduct tax only on 8 lakh rupees. So he'll reduce, the loss under the head of house property out of the salary income, and only thereafter, he'll go on to deduct tax. Understand here it is only the loss under the head of house property which is deductible out of salary, while deduction of tax. In case of employee having loss from other sources, he can, either from business or from any other source. It could be a depreciation loss, which a lot of, which could be deducted from the head of salary. So in such cases, it is the employee who should claim the other losses out of his return of income while filing his return of income. It is not, employer is not obliged, and in fact, employer is duty cast not to give any benefit of loss other than the loss under the head of house property. Similarly, what he could go ahead and say is that I have made tax saving investment under section 80C, right, to the extent of 1,50,000. So what if at all proof is provided by the employee that yes, indeed he has made those tax saving investments, in that case, the employer would go on to reduce even the tax saving investment or the chapter 6A deduction, right? A lot of chapter 6A deduction is available where the employee furnishes proof to the employer, he'll deduct tax at a lesser amount. So he would end up, deducting tax on 6,50,000 rupees. And this is how, the employer and the employee, they end up paying tax during the continuation of the year. So employer shall take into account the above particulars into account while calculating tax deductible at source. So particulars of other income, particulars of any other tax deducted under any other provision. So if the employee has got any other TDS, he would also incorporate that, and loss under the head of house property. Apart from the deduction of tax, the employer is also obliged to not only deduct tax, but he should also furnish to the employee complete details of perquisites or profit in lieu of salary. Now, perquisites are in-kind benefits. So at times, very difficult to value. How the valuation has been done, the employee should know about it. And therefore, there is one form 12BA which has been prescribed wherein the employer is supposed to give all the details of such in-kind benefits extended by the employer to the employee and profit in lieu of salary. So what he got to do is 17 to IV, all the items falling under this head, he'll have to give by way of form 12BA. I'll just show form 12BA to you. Just, when you see it, you'll understand that it covers almost all the benefits which are given in kind. So you have in front of you form 12BA. Now this is furnished by the employer to the employee. Look at this form 12BA, particulars of perquisite, other fringe benefit, amenities, profit in lieu of salary. So all perquisites, all non-monetary perquisites like, rent-free accommodation, car, watchman, gardener, sweeper, gas, electricity, interest-free concessional loan. This we have duly dealt, all of these items while we were discussing salaries. So value of perquisite got to be given, amount recovered from the employee got to be given, and finally what is taxable as non-monetary perquisite, or perquisite basically got to be given. Not only that, even the profits in lieu of salary got to be provided for in this particular form. So basically, what he is doing is he is giving all the valuation of non-monetary perquisite, what is the amount of tax deducted out of salary of the employee on such non-monetary perquisite, that has to be specified here. Also, whatever tax which the employer has paid on such non-monetary perquisite, that is under section 192(1)(a), we did discuss this. Sometimes it is the employer who pays on behalf of the employee. So if he had paid it, that also got to be disclosed. So this form got to be given to the employee so that he is aware of how the valuation has been done. And since we are into the forms, let me show you another form, and that is Form 12BB, which is to be provided by the employee to the employer, right? Form 12BA was provided by the employer to the employee. Form 12BB got to be provided by employee to the employer. The intent of 12BB is that the employee should, along with supporting evidence, give the details of tax saving investments that he has done, the loss that he has incurred under the head of house property to the employer. So it is in a structured manner that the employee is providing that information. If the employee doesn't provide this information along with evidence, the employer would go on to deduct tax on the entire income without taking into account the tax saving investment which the employee has done. So employee would end up paying more amount by way of TDS. Now, if he pays more amount of TDS, it is not that he is not going to get refund. He could always claim Chapter 6A deduction while filing his return of income. So you have got 12BB, which you have got details such as how in respect of house rent allowance. So it is covered by Section 1013A. Exemption would be given by the employer only if employee provides for the proof of actual rent paid by him. So if the employee has not paid any actual rent, you are aware that Section 1013A is not applicable, right? Nothing would be exempt. He gives away the rent paid to the landlord, gives away the rent agreement or the rent receipts. So that is how, with evidence, when the employer provides the information, I'm just going through the form. You could just read it and you will understand that it is the employee who gives all the information, and only thereafter, after the information is received, would the employer not deduct tax on the tax saving investments which you have done, or he'll give the benefit to the employee in respect of the exemptions or deductions which are available under the Act. So virtually, factually what is happening under Section 192, the employer is, put into the shoes of an assessing officer, wherein he is required to, find out the actual income, taxable income of the employee and deduct tax on that amount. So ATC, look at this, deduction under ATC got to be provided subject to furnishing of proof. So you've got ATCC C, ATCC D, and there are a few sections of under Chapter 6A which are further eligible to be, which could be provided for by the employer. However, there is Section 80G and 80GG which is not provided for the employer while filing, while determining the amount to be deducted out of salary income. That is for the assessee to claim in his return of income. Right, so this is Form 12BB. And after Form 12BB is furnished, he would decide the final amount on which tax is to be deducted. In this case, which we have discussed, he is deciding that tax would be deducted at on the total taxable income of 6,50,000. So tax would be deducted. Now, once the tax is deducted, he should pay. Who should pay? It is the employer who should pay the amount. Employer should pay the amount to the credit of the government, right? So employer would have to pay the amount of TDS on behalf of deducted out of the income of the employee. Now, what is the proof that the employee has got regarding the deduction of tax? Well, every employer or every deductor for that matter is required to provide a certificate of tax deduction. Now, this certificate of tax deduction is provided by the employer to the employee in Form 16. So it is Form 16 in which in which the employer provides for tax for the proof of yes, the indeed tax deduction has been made out of the income of the employee. Let me show you Form 16. You'll realize. To move. All right. Fine. We don't have Form 16. I'm unable to move the screen somehow. Let's focus here. So Form 16, in Form 16, you know what the employer certifies? He certifies the amount paid as salary, right? And the amount of TDS made out of such salary. Apart from the certificate of TDS, it also has particulars of salary paid by the employee, paid to the employee during the year, right? So taxable, the working of taxable salary is provided, and also taxable income. So he gives all the particulars whichever is available with him by way of Form 16. So employer not only certifies the amount of TDS, but he also, is providing the details of taxable income of the assessee and the tax deductible on such taxable income and how much he has deducted. Sometimes what happens is, there is a shortfall in deduction. The tax payable by the employee is 50,000 rupees. However, the deduction is 45,000 rupees. Now this could lead to, a shortfall in deduction. Sometimes what happens is, the tax payable was worked out at 50,000 rupees. However, the employer deducted 55,000 rupees. Now, whenever there is a shortfall in tax deduction, it would become still the employee's liability to pay for the shortfall. We've discussed section 191 just a few while ago. It did indeed cast responsibility even on the employee to make the payment of tax even if the employer has not deducted. So direct payment would have to be made by the employee even if tax has not been deducted by the employer or there is a shortfall in making deduction of tax. So let's see what are the proofs which got to be given along with Form 12BB by the employee to the employer. So while he's, claiming the exemption under section 1013A, he got to give the proof of payment of rent to the landlord. Right. So whatever rent receipt he has got, he will have to provide it to the employer. Now, once the employer provides the rent receipt to the, employee is providing rent receipt to the employer would compute the exemption under 1013A and would provide for the exemption. So what he got to give is not only the rent receipt but also PAN of the landlord if the rent actually paid by the employee exceeds 1 lakh rupees during the year. So this is mandated off late by the government because a lot of employees, they were exploiting 1013A by providing fake rent receipts, and therefore what they did is they brought in a specific provision where they brought in a rule which said that if you have to claim 1013A for rent paid above rupees 1 lakh, you'll have to provide PAN of the landlord. Similarly, when it comes to LTA exemption under section 10(5) of the Act, you'll have to give the amount of proof of the actual expenditure incurred by you on travel. It is only the travel which is covered by 10(5). Do remember, it is not the other items which are covered by 10(5). Only the cost of travel is covered. Similarly, in case of income from house property, is supposed to give the name, address and PAN of the lender. And not only that, he'll also, supported by the certificate issued from the lender relating to the home loan interest that he has paid. Thereafter, deduction under Chapter 6A, he'll give the evidence of investment of such expenditure. So once it is done, once all of it is given, what he can do is he can give an allowance for all these items and only what is remaining would become taxable. So let me just briefly what we do is we just check out who's the deductor here. Tell me who's the deductor. I'll also check on queries. 192 is one of the very important provisions and one of the very important tools for collection of tax. Let me just check it out. Let me just check out the queries. By the time I'm checking out the queries, you tell me who's the deductor under this section, on what amount the the tax is deducted, who's the deductee, and at what rate tax got to be deducted. So you're going to give me the rate of TDS, you're going to give me who's the deductor, who's the deductee, right, and what is the income. What is the item of income on which tax is deducted? I'm just, I'm giving you some time. By the time you give me the answers, I'll go through the queries. Yes, Payal is asking whether the manner in which salary is computed under Section 15, whether the same manner you have to compute TDS. Well, TDS got to be computed by way of taking the average tax rate on estimated income. But the final tax liability, that would be always equal to the amount of TDS. So TDS it could be more or less at times, but then it should be around the total tax liability of the employee. So yes, ultimately it all depends on how you compute the income under the head of salaries. So knowing the provisions of salary is very important if you were to deduct tax under Section 192. It is usually the HR department of a company, who deducts TDS on salary, and they are very well versed in computing salaries under Section 15, 16 and 17 and the rules made, thereunder. Then right, Payal is asking the amount of tax deductible should not be reduced as a consequence. Well, Payal, could you please elaborate your query further? So why PAN of landlord is to be disclosed? Well, while PAN of landlord got to be disclosed because it ensures that yes, indeed there is a landlord. Christian is asking if loss from house property is 2,40,000. Well, 71(3)(a) would employer would restrict it to 2 lakh rupees. So even if the loss is 2,40,000, yet the maximum loss available is 2 lakhs. He would have to give effect to all the provisions of the Act. Yes, Mansha, you're right. 26 AS does show amount of TDS. Well, I've not been there, but since you've asked a question, it is not only the certificate which the employer gives to the employee relating to TDS, but the employer is also required to file a TDS return in Form 24Q. And because of that TDS return, the government gets all the details of the tax deduction made by the employer in respect of the employee. There is a distinct form which the employee can get from his own account of income tax, and that form is called as Form 26 AS. So as you get into your articleship, and if you work in income tax, you'll realize that there is something called as Form 26 AS. It is a little premature to discuss it at this point in time, but then understand that the deductor would always issue a certificate to the deductee. Yes, now TDS is not to be, well, this is a very good question. I did not discuss it. When you got to make the payment of TDS, see, every month you make a payment of salary. So since you make a payment of salary every month, you will have to deduct tax at the time of payment every month, applying the average rate. The moment you deduct the amount of TDS, you will have to deposit it in the subsequent month. See, generally what happens is, let's assume 30th of June is the salary that you're paying. You'll deduct tax on 30th of June, and once you deduct it, you will pay on until 7th of July. We'll come to the due dates of making payment of TDS, but for the timing, understand 7th of the succeeding month in which tax is deducted by the employer. So he'll have to pay it on a monthly basis and not annual basis. So Shivam, you make a valid point. It is to be paid on a monthly basis if the salary is paid on monthly basis. Then, and it is to be made at the time of making payment only. So there is this a little bit of deviation between section 192 and section 15. There is a trade-off there. In respect of section 15, section 15 would require you to tax salary on due or receipt basis. However, section 192 would cast liability on the employer only to deduct tax at the time of making payment. Then Sai is asking, is there a limit to exceed to pay TDS? Well, in case of section 192, there is no threshold limit. The threshold limit is, the basic exemption limit, or whether tax is not payable by the employer, by the employee. Like I said, on 5 lakh rupees of total income, an employee would not be required to pay any tax. So the deductor is not required to deduct any tax. So it goes with the tax liability of the employee in case of section 192. Apart from section 192, all other sections would have either the limit or no limit, right? And the rate of tax is specified. It is only section 192 where the flexibility is given, as far as the rate of tax is concerned. So if deductor fails to deduct tax, Karthik is asking if the deductor fails to pay tax, whether the employee is supposed to pay, calculating the estimated income. That is what I understand. Well, no, in that case, employee got to discharge his tax liability. If the deductor is not deducting tax, he got to pay advance tax. We'll come to the provisions of advance tax, or, the self-assessment tax while filing his return of income. So no duties cast on him to pay at the average rate. If the Shivani is asking, if the employer does not deduct TDS and the employee after pays it, whether employer be assessee in default? No. Well, we'll come to it, Shivani. We'll discuss this. What if the employee pays the amount of tax which was payable, which was deductible by the employer on his own, whether the employer is an assessee in default? Well, he is not an assessee in default. We'll check this out entirely. So wait for some time. It is provided that except in cases the loss has to be adjusted against salary, the tax deductible from salary. Pyle is asking, the tax deductible from salary should not be reduced as a consequence of making the above adjustment. Well, the employer is, duty bound to provide only for the loss under the head of house property. If it is any other head, he's not, neither he is liable nor he should actually provide for a deduction for other losses. It is for the employee to claim it in his return of income. So he'll deduct tax only after deducting loss under the head of house property. That's it. Because the loss under the head of house property is a little simpler to determine. If the deductor is supposed to, compute the business loss or a loss under any other head, it would become very difficult for the deductor. I did explain, deductor is put into the shoes of an assessing officer here. You cannot put him under a lot of liability to compute the total income of the employee. He is supposed to make only the prima facie adjustment. Logically, also, only house property would be loss under the head of house property is allowable. Well, nobody answered my question. Who's the deductor? Who's the deductee? We've been, taking up other queries. Is the assessee have to pay salary in his return, even if TDS. Yes, yes. What Ronit is asking is whether the employee would have to show salary income in his return of income despite TDS being made by the employer. Yes, TDS is only facilitating tax payment to the government. As far as the return of income is concerned, it is the assessee who is liable to file return of income, and he should show all of his income from all the sources in his return. So, including the head of salary. Well, there is a important question here. Kashish is asking, if the employee leaves the job in the middle of the year and do not join any other employment, moreover, taxable salary also does not exceed the taxable limit, but the tax have been deducted, can the assessee claim refund of the same? Well, yes, certainly. Now, this happens, Kashish. What happens is the employer starts deducting tax from the first month itself and at the average rate. Now, what could happen? The employee could leave in the mid of the year and his income never exceeded, the taxable limit, but tax deduction have been made. In such cases, the employer could file his return of income and claim the credit of this TDS paid. So it is the credit of TDS which is available while filing return of income, and he could claim refund of the tax so deducted, exceeding the amount which was payable by the employee. So right, I guess a lot of queries have been answered. One of the very important TDS related sections is section 192, contributes to a lot of revenue to the government and therefore monitored strictly. Every deductor is required to file 24Q, give away all the details of how he has provided for deductions and exemptions. Even the deductee is supposed to file form 12BB with the employer. So deductee here would be the employee, deductor would be the employer, the income would be income from under the head of salaries, and this pie is TDS, which is actually paid to the government calculated at average rate, but at most of the times, wherever the employer is not in default, he'll deduct the entire amount of tax payable by the employee on the amount of salary. Then, see at what rates, again, there should have been one question nobody asked me. What are the rates of at which I should compute the amount of tax? The tax got to be computed at rates provided in part 3 of schedule of the first schedule to Finance Act. Finance Act, the rates are given in the Finance Act and not in the Income Tax Act. It is not Income Tax Act which provides for the rate of taxation. It is the Finance Act. So where do you find that until 2.5 lakh rupees to 5 lakh rupees you got to pay 10% tax, 5% tax. So it is in the Finance Act of every year. Now let's assume Finance Act 2020. Now it provides for rate of tax for the assessment year 2021 in the first schedule. First schedule of part 1 of first schedule would provide for the tax rate relating to AY 2021. However, when it comes down to TDS, friends, what happens is you're paying it in advance, and therefore during the year 2021 you will collect tax for AY 21-22. Do you all agree with this? Understand this very carefully. While you are in the financial year 2021, what you are going to do is you are going to deduct tax in respect of the assessment year 21-22. This rate is provided for in the third schedule. The third part of the first schedule. It is part 3 of first schedule where the rate of advance tax and rate of TDS on salaries is provided for. As far as the other rate of TDS is concerned, I'll discuss. It is provided into Part 2 of the Finance Act. Right. So for AY 21-22, the rates are provided in Finance Act 2020. Similarly, for AY 2021, the rates are provided by Finance Act 2019 in the third part of the first schedule. Now, this third part of the first schedule would become first part of the first schedule in the subsequent Finance Act. So, in what I mean to say here is, when the Finance Act 2021 is released, the first part, of first schedule would be the third part of the preceding year. So you could just, I understand it could be a little confusing at this moment, but then understand it is the Part 3 of the first schedule of the Finance Act. Then. Right, Shivani, you have given the right answer. Thank you. Now let's move on to the next set of deductions. TDS. 192 is entirely different from the rest of the pack. What we discuss here on is, nowhere close to 192. 192 lays down a entirely different scheme of tax deduction. Here on, say after 192A, since 192A, we'll discuss a separate scheme of deduction. Here what happens is, in this set of deduction, a fixed rate is given to us. There is going to be a deductor, certainly, every provision, whichever we are discussing would have a deductor, a deductee. The rate of TDS is prescribed. So you got to, while we are discussing it, you got to decide who's the deductor, who's the deductee, the rate of TDS, and the threshold limit. In most of the cases, there is a threshold limit. What is this threshold limit? I'll discuss in a short while. But as far as salary is concerned, it was entirely different. Now, Section 192A provides for TDS on premature withdrawal from Employees Provident Fund, right? EPF. We have discussed this while we discussed salaries. So we have discussed about the recognized Provident Fund. We have discussed about the unrecognized Provident Fund. Now here premature withdrawal of Employees Provident Fund would take into its ambit the recognized Provident Fund, right? So in case of recognized Provident Fund, where the employee, withdraws funds prior to 5 years of completion of his employment, right? He goes on to withdraw the funds, not because of some pressing reason like disability or, death of the assessee. If he is withdrawing it for any other reason prior to completion of 5 years, it would become taxable. The employer's contribution alone would become taxable. The employer contribution and the interest thereon. Employee's contribution is anyways taxed. So whatever is taxable is withdrawn by the employee. And if it is taxable, if it is premature and if it is taxable, the Provident Fund, which is making payment to the employee, should deduct tax at the rate of 10% on such premature withdrawal. So now you could name who's the deductor, who's the deductee, what is the rate of tax. And let's come to the threshold. So see, who's the deductor? It is the Employees Provident Fund, the trustees of the Employees Provident Fund. Generally, Provident Fund have got trustees. So whoever the trustee is, he is tasked with the liability to deduct tax in case of such premature withdrawal. See, if it is not premature withdrawal, let's assume, the Provident Fund is withdrawn after the retirement of the employee. In that case, no tax is to be deducted. Tax is to be deducted only in case of premature withdrawal, and that too in respect of only the amount which is taxable under the Act. So let's check. The rate of deduction is 10% on premature taxable withdrawal from the Employees Provident Fund. And it should be made at the time of making payment. So we are discussing, making payment at the time of making payment. The person who's paying such withdrawal to the employee, and if it is premature, taxable. See, it should be taxable. If it is not taxable, nothing is got to be deducted. No TDS got to be made out of the payments. And there is also a threshold. Now, what is the threshold? No tax deduction is required to be made under this section if the amount of payment or aggregate amount of such payment to the payee is less than rupees 50,000, right? So up to rupees 50,000. Now, under the provisions, there are many times, you find either exceeding 50,000, in some cases it would be less than 50,000. There is no one rule. So sometimes 50,000 is included, sometimes 50,000 is excluded in some of the section. We make it a point while we are learning each of the provision. We would make it a point that we talk of exceeding a particular limit, right? So that we bring all of the limits on a level playing field. So anything paid, any withdrawal, premature withdrawal of EPF by an employee, if it is made exceeding, so we are talking of exceeding 49,999, right? TDS would have to be made. Anything exceeding, so 50,000 is included. Anything less than 50,000, you're not to deduct tax. Anything exceeding 49,999 would become taxable. Now, what happens in case, so what is the rate of TDS here? It is 10% and got to be made only if the premature withdrawal is exceeding rupees 49,999 or or it would be exempt if it is less than 50,000. The deduction would be made at maximum marginal rate in case of non-submission of PAN by the payee. So if payee does not give PAN, if no PAN is furnished to the Provident Fund by the payee, tax would be deducted at MMR, right, at maximum marginal rate. What is the MMR for 2020-21? AY 2021, what is the MMR? Tell me. And also tell me who's the deductor under section 192A. Section 192A on who's the deductor deducting the amount of the rate at which TDS got to be deducted and what is the amount paid. And the MMR, tell me what is the maximum marginal rate. See, if the deductee here, who is the employee, he does not give PAN. He does not give PAN to the trustee of the EPF. He ends up deducting tax not at 10% but at MMR. Now, what is this MMR? Maximum marginal rate. Shaikat is saying 35.88%. Shaikat, how have you calculated it? Just explain how the calculation is made. Yes, Harsh comes out with a figure that is 22.744. percent, and he seems to be right. So while we discuss what is, what is the rate, we also discuss how it is to be computed. Harsh, how did you compute it? You're right. How did you compute it? The rate of MMR would be 42.744, but how has he computed that rate? Well, let us wait for his answer. By that time, deductee would be the employee who has contributed to the Provident Fund. Deductor would be the Provident Fund, the trustee of the Provident Fund who is actually paying the amount of withdrawal, premature withdrawal. So this is your premature withdrawal. And on this premature withdrawal of PF, you end up paying 10% as TDS, and in any case, it would become taxable in your return of income. Deductor is not the employer here. You would be wrong if you say that deductor is employer. Deductor is the Provident Fund, right? It is the trustee of the Provident Fund who would be the deductor. So it is not employer. Yes, Mansha, how did you compute 42.744? Harsh, Mansha. Yes, you're right. It is 42.744 indeed. How is it computed? Mansha says it is 30%, that is the maximum rate of tax, plus surcharge, which she is saying 30%, which I do not agree with, and 4% education cess. Adding all three of it, Mansha, would not give you 42.744. So on premature withdrawal, 10%. So look at this, the maximum marginal rate would be the highest slab rate plus the highest rate of surcharge, which is 37%, right, for the year under consideration. So 37% of 30% plus 4% of both of them taken together as higher education cess. So if you calculate it together, you'll arrive at this figure which Harsh, Janvi and Mansha has rightly stated. So this is the maximum marginal rate. You got to deduct tax at maximum marginal deductor in case if the in case of premature withdrawal done by the employee, provided it does not provide PAN, right? So if he's not providing PAN, you have to deduct at MMR. Very, very important. So PAN, furnishing PAN to the PF, Provident Fund, very important. Else you would be paying a very high rate of tax. Then let's move on to interest on securities, section 193. Now, see, you pay either interest on securities or interest other than interest on security. What is a security? Well, security would mean those instruments which are governed by the Securities Contract Regulation Act, the SCARA. Right? Anything that is governed by SCARA would be security. So security would be debenture and bonds, or it could be zero coupon bonds. It could be any other security, any security which is covered by SCARA. So there are a whole lot of securities. Now whether fixed deposit is a security, the answer is no. It is not governed by the Securities Contract Regulation Act, and therefore it is not security. No tax has to be deducted under section 193 for non-security item. Interest arising on security, interest arising on other than security. So normal loan given by one person to another person. Now it does not arise on account of security. Security would be my debentures, preference shares, etc., etc. Now, person responsible for deduction of tax here, therefore, one who issues the security and one who pays interest on such security, right? So it is the issuer of the security who is responsible. Understand who is the deductee here. Deductee is the person who derives interest. Now, all the sections which we are discussing would cover, resident assessee. If it is a case of non-resident, the TDS is governed by section 195 mostly. right? There are a few sections which cover non-resident distinctly, but then most of the times it is section 195 which governs the TDS in case of payments to non-resident. It's not covered by your syllabus. When you come in final, I'll probably take it. But for the timing, understand the person who's the deductor, it is the person who has issued security and who is paying interest on that security. What is the rate of TDS? It is 10%, right? So 10% would be deducted if at all, a person who has issued 10 lakh rupees of debentures, he pays interest at the rate of 10%. So 1 lakh rupees would be the amount of interest which the issuer of security would pay. He would deduct 10%, that is 10,000 rupees would be deducted, and the investor would end up getting only 90,000 rupees of interest. Then, so what is the time of deduction? When do you got to deduct? See, we have discussed the amount of deduction of tax under section 192A. We have discussed that it is on premature withdrawal. But when it is to be deducted? Only at the time of making actual payment. Right? It is the actual payment when you got to make deduction of tax. As far as interest is concerned, whenever you come across something like an interest, in case of interest, deduction got to be made either on actual payment or at the time of credit to the account of the payee, whichever is earlier, right? So very important, some of the sections would require you to deduct tax even while you credit the account of the payee, right? So you don't make an actual payment, you only make a credit to his account. When you talk of fixed deposit, now each one of you know the concept of fixed deposit. What is the fixed deposit? You go to the bank, you deposit your money, and the bank is paying you interest on a periodical basis. Now that interest would accrue to you every day, but it would be credited to your account at a specified interval, generally on a monthly basis, and it would be paid to you, at the maturity time, at the time of maturity. So basically, what happens is the bank would credit your account on a periodical basis, but it would pay you only at the end of the maturity tenure. So I am not going to deduct tax at the time of maturity because that would delay my deduction. And therefore, what they say is at the time of credit or at the time of making payment, whichever is earlier. So it is the time of credit or the time of making payment, whichever is earlier. Do you get this, friends? The time of tax deduction and the rate we have discussed, it is 10%. In certain cases where the security is issued by government or some organization of eminence, deduction is not to be made under section 193. Those bonds which are issued for national defense purposes in the year 1972, no tax got to be deducted in such case of bonds, right? These bonds are securities. However, because of a specific exclusion, you're not to deduct tax on the interest accrued on these bonds. National Defense Bond of 1972, probably, when I look at it, maybe obsolete now. 1972 is the year of war. We were at war with our lovely neighbor, and that time the bonds would have been issued. So we required money and therefore the bonds were issued, and government would have said that we will not deduct tax at source. So it's an incentive in a way. But when you look at it, the more recent of the bonds notified is the Power Finance Corporation 54 EC capital gain bonds. So you're not to deduct tax, as a Power Finance Corporation would not be required to deduct tax on its 54 EC capital gain bonds. We have discussed 54 EC while we discussed capital gains. So until 50 lakh rupees of investment in these bonds, you could get an exemption under the head of capital gain. If you prescribe for the Power Finance Corporation or the Indian Railway Finance Corporation in respect of 54 EC bonds, there would be no deduction of tax on interest paid on such bonds. Anyways, the rate of interest on these bonds are very less in any case. So you've got gold bonds of 1977, but in all other cases, in case of debentures, etc., the rate, the threshold limit is 5,000. So when it exceeds 5,000, you know, if it exceeds 5,000 rupees of interest, you got to deduct tax at source. On any debenture, let us see this. This is important. On any debenture, whether listed or not on a recognized stock exchange, issued by company in which public is substantially interested. So essentially, it is not a private company. To a resident individual or HUF, right? So it is only the resident individual or HUF. If the interest is paid by way of account pay check, so interest on the debenture is paid by account pay check, the first condition, and the second condition, the amount of such interest or aggregate thereof would not exceed 5,000 rupees. So, exceeding 4,999, the interest on debentures would be subjected to tax if it is paid to individuals and HUF. In respect of any other assessee, where the issuer of security is paying to any other assessee, there is no threshold limit. Threshold limit is only in case of individuals or HUF, and that too in case of debentures. Right, so I hope you get it. The interest on securities. So who's the deductor, friends, here? Who's the deductee? The rate of TDS. So in case deductee would be a resident investor. Resident investor. Deductor would be one who issues the security and pays interest. TDS got to be deducted at the rate of 10% on the amount of interest. And understand, interest either got to be credited or paid. If the interest is very small, in case of individual, very small is below 5,000 rupees, or only if it exceeds 4,999 would it be considered as big, right? So if it is small pie, you're not to deduct tax at source. So do you get this? Section 193. Let's move on to the next section. Now this is again very widely used section 194A. In case of securities, you've got limited securities which are issued and subscribed, but this covers every interest payment except for, interest on securities. Why other than interest on securities? Because interest on security is already covered under section 193. So you have not covered it again. All interest other than interest on securities would be governed by section 194A of the Act. Well, yes, I've got some very good answers. Deductor, deductee. Well, Shivani is asking, yes, 5,000 rupees. As far as the 5,000 rupees of limit is concerned, the condition to claim that 5,000 rupees limit is that you should pay by account pay check alone. So even if it is, below 5,000 rupees paid in cash, the limit would not apply. When you make a payment through banking channel, the payer has to anyways offer it to tax. So generally, therefore, the major thrust is on payment through banking channels. But then it is only this section 193, where the threshold is governed by account pay check. Otherwise, in no other case, the threshold is governed by the mode of payment. Threshold is a threshold. So when we look at 194, you'll understand the threshold limit. It is not governed by any of the mode of payment. It could be any mode, yet you can claim the benefit of the threshold limit. This section deals with scheme of deduction of tax from interest other than interest on securities. Now it applies. So who is the deductor here? Deductor is any person, right? It is any person. Now any person would cover every individual, every HUF, every AOP, BOI, even the small of the assessee who makes a payment of interest. And therefore what they said is any person except for, right? Other than. They say other than individuals and HUF, right? Other than individuals and HUF. So deductor is any person other than individuals and HUF. Now there is one more condition here. So now what happens is if you remove individuals and HUF out of any person, the base of deductor becomes too small. And therefore they said other than individuals and HUF who are not subjected to tax audit under section 44AB. Right, who are not subjected to tax audit under section 44AB, clause A and clause B. Now, look at this, what they have done in the process. They have reduced the hardship on small assessees, but they haven't reduced the hardship for the large assessees who have got sumptuous turnover. So any individual or HUF having a turnover from business of exceeding 1 crore, and 50 lakhs in case of professional would have to deduct tax under section 194A, even though he is an individual or an HUF, since he is a large assessee. So basically it covers any person who makes a payment of interest other than interest on security, being, other than individual or HUF, but excluding individuals and HUF who have a turnover exceeding the monetary limit of 1 crore or 50 lakh rupees as provided under section 44AB. Right, so 44AB, A and B, clause A and clause B would now here, govern the tax, the liability to deduct tax. So see here, the liability to deduct tax is dependent on some other section of the Act. So if you are not aware of the limits prescribed under section 44AB, you will not know who is required to deduct tax at source under section 194A. You will have to read 44AB in order to understand which individuals and HUF are covered. Now, it is only clause A and B which are covered here, exceeding 1 crore rupees of turnover and 50 lakh rupees in case of profession. Then, so deductor is finalized, we now know the deductor. Deductor is any person excluding individuals and HUF, but not excluding individuals and HUF who have got a turnover exceeding 1 crore or 50 lakhs as the case may be, right? Then when do you need to deduct tax? Tax has to be deducted at the time of making credit to the, to the lender or at the time of making actual payment. So when you are making payment to the depositor or the lender, right, you will have to deduct tax at the time of making payment or at the time of crediting his account, whichever is earlier. Now, we did see, in case of section 192, it was on actual payment. In case of section 192A, it was on actual payment. However, here it is crediting or actual payment, whichever is earlier. Now, credit can happen to any account. They go on to say that credit does not mean credit to the account of the depositor or lender only. Credit can be done to either interest suspense account or interest payable account or suspense account, by whatever name called. If you are making a provision for payment of interest, even then you'll have to deduct tax and pay it to the government. Then as far as banks are concerned, banks are into core banking system. See what could happen. In case of banks, bank would pay interest on fixed deposit. Now this interest on paid on fixed deposit, this payment is subjected to TDS under this section 194A. What banks do, banks have got multiple branches. You go to each of the branch and make a deposit there. What bank would do is aggregate all the interest payment from all the branches. All the branches where you have kept the deposit, all the interest payment would be clubbed together to find out your threshold limit, whether you have exceeded the threshold limit or not. That is provided by way of circular number 3 of 2010. We'll just check the rate of TDS. The rate of TDS is 10%. Now the rate of TDS is provided for in part 2 of the first schedule of the Finance Act. So it is not provided for in 194A, but it is provided for in part 2 of the first schedule of the Finance Act. As far as the rate of TDS for salary is concerned, it is provided for in part 3 of the first schedule. As far as 194A is concerned, it is provided in part 2. In certain cases, you don't have to go to part 2 of the first schedule. It is provided in the Act itself. We'll check those, those sections as well. However, so TDS is to be made by any person paying interest at the rate of 10%, except for, there is a threshold limit, and the threshold limit is except where the interest does not exceed 5,000. So it should be 4,999, like we saw in section, it does not exceed 5,000. So exceeding 5,000, right? So up to 5,000 rupees, you don't have to deduct tax. In 194C, 193 we saw that it was 4,999. Here it is exceeding 5,000. The moment it exceeds 5,000, you'll have to deduct tax at source. So the threshold limit in case of payment of interest is 5,000. However, an enhanced limit is provided when it is the interest which is paid by a banking company, right, or a cooperative bank or post office. In all three cases, this 5,000 is increased to 40,000. So the threshold limit would be 40,000. Only if the interest exceeds 40,000, from all the branches taken together, only then you will have to deduct tax at source. So in case of a banking company making payment to depositor, right, for interest, in that case, the bank is supposed to deduct tax at source only if the total interest exceeds 40,000 from all branches taken together, right? So State Bank of India would have number of branches, right? So you open one account in one branch, second in the other. All the interest that is paid by all the branches would be clubbed together in order to determine your limit of 40,000. Now this 40,000 is further enhanced to 50,000. It is further enhanced to 50,000 in case of a senior citizen, right? So in case of senior citizen, you get some additional advantage, 40,000 increased to 50,000. But this is applicable, mind you, do remember that this is applicable only in case of payments made by banking company, cooperative bank or a post office, right? And not by any other assessee. So if it is, you have lent to your friend, right? And, you have so we have got Karan here. Karan makes a loan to Sanjay, right? And Sanjay pays interest to Karan, right? Now this, for here when Sanjay makes a payment to Karan, and if Sanjay is governed, has a turnover of exceeding 1 crore rupees, he'll have to deduct tax at source at the rate of 10%. Right now, but then, he makes a payment of, let's assume, 34,000 rupees to Karan. Now, whether he got to deduct tax at source, whether Sanjay would have to deduct tax at source, the answer is yes. He'll have to deduct tax. Why? Because it has exceeded 5,000. Right? The interest amount has exceeded 5,000 rupees and therefore Sanjay would have to deduct tax at source. However, had Karan instead of lending to Sanjay, had he kept his money with State Bank of India, and State Bank of India would have paid current an interest of 34,000, in that case, whether TDS would have been made by State Bank of India? The answer is no. The limit of 40,000 was not crossed. So it is, in case of a banking company is not required to deduct tax even if it exceeds, 5,000, but it does not exceed 40,000. In case of senior citizen, the limit is that of 50,000. Now this you could understand, limit of 50,000 is, in sync with one of the sections that we had seen, 80 TTB. Right, in 80 TTB, a senior citizen got a deduction of 50,000 rupees. So we are, linking two provisions of the Act, right? 50,000 rupees on all kinds of deposits. Yes, so then, the limit will be calculated with respect to income credited or paid by branch of a banking company. In case of time deposits, only time deposits. So what it means here is saving deposit. Any interest that you earn on saving deposits on your saving account, right, is not covered by 194A, and therefore you don't see any deduction under section 194A on the interest that is credited to your saving bank account. So if it is saving bank account, no TDS, it is only the time deposits. Time deposits are those deposits which mature after a particular time. So it is like 1 year time or 1 month's time, 15 days time. All of these are time deposits which mature at a particular point in time. Only interest thereon paid by bank would be tax deductible. However, in case of any other any other borrower who pays you interest, he'll deduct tax on any kind of interest payments to you, provided it exceeds 5,000. Right, provided it exceeds 5,000. So you have got couple of limits there: 50,000 in case of senior citizen, 40,000 for all other assessees who are receiving interest from bank, cooperative bank, or a post office, 5,000 in all other cases. Further, for the sake of convenience and for retaining the logic of 194A, there are some more exemptions which have been given under section 194A. One of them is, interest paid or credited by firm to its partner. Firm to partner making payment of interest, no tax got to be deducted by, the firm while it pays interest on capital to the partners. Essentially, partners and firm is not different, and therefore no deduction is required to be made, specifically exempted from the rigors of 194A. Similarly, cooperative society paying interest to its members, again no deduction is required to be made. When cooperative society makes payment to members, what happens is there is a mutuality. Now member make the society and society is of the member. Since there is mutuality, therefore section 194A specifically leaves aside any payment by cooperative society to its member. Similarly, interest income credited or paid in respect of deposits other than time deposits. I have already discussed this. Other than time deposit, only interest TDS got to be deducted in respect of interest that you earn out of time deposits and not from other deposits. So saving deposits are out of it, or other deposits other than time deposits are out of it. In other words, demand deposit, any interest that you earn on demand deposits with a banking company, no TDS would be made. So there are a few of those other options. Look at this. This is one important: interest paid or credited to the following entities. When interest payments are made to, by one person. Let's assume you borrow from HDFC Bank. You borrow some loan from HDFC Bank. Now you are the payee, right? And you are paying to HDFC Bank. Now whether you should deduct tax while you make payment on loan to HDFC Bank, the answer is no. Why? Because you have got a specific exemption when interest is paid or credited to banking company, financial corporations, So if you are making payment, or if any assessee is making payment to a banking company or a financial corporation, they're not supposed to deduct tax. Similarly, insurance company, when you're making payment of interest to insurance company, you can take a loan on insurance policy. You are not supposed to deduct tax while making payment. Unit Trust of India, or something like a NSDF, National Skill Development Fund, or Housing and Urban Development Corporation, that is HUDCO. When you make payment to notified institutions, you're not supposed to make any tax deduction at source. So a deductor would not deduct when he is paying interest to such notified institutions, specifically exempted institutions. Similarly, interest credited by interest on compensation amount, right? So any credit of interest on compensation under the Motor Accident Claims Tribunal, well, interest paid. So credit would not invoke any TDS, but when the interest is actually paid, there would be a case of TDS, provided the interest amount on such claim exceeds 50,000. So if it is, the interest on motor accident claim exceeding rupees 50,000, you got to make TDS under section 194A. So that brings me to the end of section 194A. I'll take up some questions for 194A, but then, you have to tell me who's the deductor, who's the deductee in this case, and what is the amount and the rate of TDS, threshold limit and the rate of TDS. By the time I'm taking some queries, 194A again is very, very prevalent. Kristen is asking, but under 80 TTA we have a 10,000 limit. Well, Kristen, the subject matter of 80 TTA is only saving interest. On saving interest, there is no deduction under section 194A of the Act. I have clarified that. Shivani is asking whether the 50,000 limit is applicable to a senior citizen even if the payment is made by an individual or HUF. No, Shivani, 50,000 rupees of limit is applicable only if the payment is made by bank, cooperative bank, any banking company, cooperative bank, or the post office, like we discussed earlier. Look at this. In respect of 1, 2 and 3, that is time deposit with banking company, time deposit with a cooperative bank, deposit with post office under notified scheme, 1, 2 and 3, above limit would be, I mean to say 40,000 would be 50,000 in case of payee being a senior citizen. So I hope I make myself clear here. Next. So who's the deductor? Deductor is the person who makes a payment of interest. So interest, what is the rate of TDS? The rate of TDS is 10%. Deductee would be, either a depositor or a borrower, or a lender. Deductee would be a depositor or a lender. So one who makes payment of interest would be a borrower. Borrower paying to the lender any amount of interest, he got to first deduct tax at source at the rate of 10%. What is the threshold limit? The threshold limit is 5,000. So anything that exceeds 5,000, right? Exceeding 5,000, so 5,001 onwards, you've got to deduct tax at the rate of 10%. This limit of 5,000 rupees is replaced by 40,000 rupees when the deductor is a bank, right, or cooperative bank, so banking company or a cooperative bank or post office, right? In that case, it would become 40,000. This would again be enhanced to 50,000 if the deductee is a senior citizen, right? So if he's senior citizen, in that case, you'll have to deduct tax only if the amount exceeds 50,000. When the deductor is a bank or a post office. Well, Shaikat, fantastic. You answer it right. 10% limit is 5,000, 40,000, and 50,000. Yes, Aditi is asking. Yes, very good. Aditi come out with such questions. Whether recurring deposit would be time deposit. Well, the answer is yes. Recurring deposit is nothing but time deposit. Time deposit have been defined under Section 194A to include all deposits, including recurring deposit, which are paid after a fixed time. So fixed maturity, you have to repay the recurring deposit. RD would be included. The interest on RD and fixed deposit, both of them would be considered together for evaluating the limit of 40,000. Just go through the problems in the module. Let's move on to next item, and that is winning from lotteries, crossword puzzles, or horse races. Now, okay, before we move, we'll take a short little break of 5 minutes, and come back again. Just have water. Now, friends, one of the queries that I expected was whether this 10% rate got to be increased by surcharge or education cess. The answer is no, it should not be increased by surcharge or education cess. As in case of 192, in section 192, we did add surcharge and education cess also while deducting tax, because there we were taking average rate of tax. Now, average rate of tax would include everything. Both the surcharge and the health and education cess. But in case of section 194A, you have a flat rate of tax at, tax deduction at source at the rate of 10%. So not to add surcharge and higher education cess, you've got to, pay tax at the rate of 10%. Now let's move to, winning from lotteries, crossword puzzles, horse races. These are all windfall gains. On such windfall gains, you are supposed to pay tax under section 115BB at the rate of 30%. Since the rate is 30%, you'll have to, deduct tax also at the rate of 30%. Now, who's the deductor here? One who is conducting the game, right? So, you happen to go on to Kaun Banega Karodpati, you are winning there. So, let's assume you win 1 crore of rupees, they'll give you only 70 lakh rupees, right? After deducting tax under section 194B at the rate of 30%. I hope you win 1 crore rupees one day on Kaun Banega Karodpati. Then, but then what you actually indeed become is not a Karodpati, you become a Lakpati, right? Only if you answer the 5 crore question, you're going to become a Karodpati. Else, you'll be a Lakpati because government is anyway going to take away 30%. Now, this rate of 30% is provided by Finance Act. So, it is, it is governed by Part 2 of the Finance Act. It's not given in the Act. It says go to, as per the rates prescribed. As far as the lotteries, crossword puzzles are concerned, again the rate is 30%. However, in case of lotteries and crossword puzzle, it is only if it exceeds 10,000 rupees. So if it is greater than 10,000, only then you got to deduct, else no need for deduction. Sometimes what happens, there is a lucky draw, or you are you just participate in a game of chance and you get an in-kind gift, or you win a prize which is in kind. So let's assume you win a car. Now if you win a car, how do you make a payment of TDS, right? Now car cannot be cut into 30%. 30%, the dicky would go to the government and rest of the car would come to you. That is not going to happen. So what they say, you'll have to evaluate the value of the car and make a TDS. Now, when you make a TDS, how do you make a TDS? The person who wins the car got to deposit the amount with the deductor. The deductor would go and deposit it with the government and issue a certificate of TDS, right? And only thereafter he, give away the car. Winnings would be released only after making payment of TDS. That is what is prescribed. In case of horse races, which are covered by 194BB of the Act, in case of horse races also the tax any winning therefrom is subjected to 30% deduction. Now understand, winning is subjected to 30% of deduction. Any loss that you incur, what could happen? A bookmaker would make your account. So how many of the bets you have lost and how many of you have won. And after that, what it does is it gives you the net gain that you have earned. But then this net gain is not subjected to TDS. It is this gross amount which is subjected to TDS under section 194BB at the rate of 30%. Provided it exceeds 10,000 rupees. Up to 10,000 rupees, fine, we are not going to deduct tax. The reason of keeping this threshold is, to give some solace to the deductor. Deductor would be posed with a lot of problem if say a person wins 10 rupees, whether he is supposed to deduct 3 rupees, the answer is no. Such immaterial amounts, there should be no deduction, and therefore, you have got the threshold. Threshold is not from the point of view of the deductee, it is from the point of view of the deductor mostly. So horse races, 30%. All these are subjected to tax under section 115BB at the rate of 30% plus education cess plus surcharge. However, here it is flat rate of 30%. Rest of it you will have to pay while you file return. You cannot escape tax once TDS is made, because what the deductor does, he uploads the return, right? Return is uploaded in form 26Q by the deductor. He furnishes all the information of whom he has paid the amount. Now, once the department is aware that you have earned something out of lottery, car, right? You'll have to file your return of income. Otherwise, the moment there is a mismatch, government knows that you have earned, but you don't file a return. They'll come out with a notice that you have not filed return despite your tax have been deducted. So basically, it's a anti-tax evasion measure as well. Let's move on. let's move on to payment of contractors. Case of payment of contractors and subcontractors. Now, applicability of TDS under section 194C, tax has to be deducted on any payment made by contractor by any person, right? Again, individuals and HUF are kept out of it, but individuals and HUF have got a turnover exceeding 1 crore or 50 lakhs in case of profession would have to deduct tax even under section 194C. Now, essential point here is, who's the deductor? The deductor would be the contractee, because it is the contractee who is making the payment to the contractor. So contractee is going to deduct tax at source while making all the payments to the contractor. Any person responsible for paying any sum to a resident contractor. See, any person to a resident contractor, we have already discussed, only non-residents are not covered. Only the resident contractors would be covered, including supply of labor for carrying out any work in pursuance of contract between the contractor and, there are a few list of contractees which is given. It virtually covers everybody. It covers government, state government, statutory corporation, society, etc., etc. It covers almost everybody. What it does not cover, although, is individuals and HUF were not subjected to tax audit under section 44AB, clause A and clause B, that is 1 crore and 50 lakhs. In case of professional, 50 lakhs. In case of businessman, 1 crore. In immediately preceding financial year, must deduct tax at source at prescribed rate from such sum. So it is the prescribed rate. Now this rate is prescribed in the Act itself. You don't have to go to part 2. You will have the rate which is prescribed under section 194C itself. So do you understand who's the deductor? Deductor is the contractee. The contractee being government, cooperative society, statutory authority, university, etc., etc., and individuals and HUF who are governed by 44AB, A and B. Time of deduction again in this case is either on payment basis or when the amount is credited to the account of the contractor by the contractee, whichever is earlier. Right, so it is whenever the contractor would credit the account of the contractor, TDS would be made. So even if it is made to a suspense account, where the credit is made not to the contractor account directly but to a suspense account, yet it is deemed to be made to contractor account, and TDS would have to be made at the rates prescribed. What are the rates prescribed? We'll go and check. When the payee, that is the contractor, is an individual HUF or a subcontractor, right? Individual HUF subcontractor or an individual and HUF, right? The rate is 1%. Other than individuals HUF, the rate is 2%. So two rates have been prescribed. One is 1% rate and the other is 2%. Now, you would wonder why such low rate has been prescribed. The reason why such low rate has been prescribed is because the contractors would be subjected to expenses, right? And they are only required to pay tax after deducting all of the expenses that they incur. And therefore, the rate is, now this amount is collected on gross receipts. Like in case of, windfall gains. For windfall gains, there was no expenditure. And therefore, deduction was made at the flat rate of 30%. That was prescribed, right? However, here, in case of a contractor, he would be subject to deductions. You are making a deduction on the gross amount. However, he is taxable on the net amount. And therefore, rate of deduction is a little lower when you compare it with other sections of the Act, right? Because he would end up paying tax on net amount, and therefore 1% rate has been prescribed for individuals and HUF who are contractors or individual HUF subcontractors. They have got a concessional rate of interest. As far as the other than individual HUF and subcontractor is concerned, the rate is 2%. Then contractor in transport business. Now transporters move from one place to another. There are these transporters, they roam across India. Now, practically, just understand there is a transporter who starts from Punjab, right? And he goes to, let's say, Visakhapatnam, right? Now, when he goes to Visakhapatnam, he travels a lot. He gets some money there. Let's assume, the consignor or the consignee pays him 50,000 rupees. Right? After he reaches Visakhapatnam, he's paid 50,000 rupees to, the lorry driver or the transporter. He's paid 50,000 rupees. What the Visakhapatnam guy does, he deducts tax at the rate of 1% out of this 50,000 rupees. So what he does is he deducts 500 rupees and he pays only 49,500 to the transporter. Now what the transporter does, he goes back to Punjab. Now just imagine this consignee at Visakhapatnam does not deposit this 500 rupees in his account. And instead, and he also does not furnish him the certificate. Now whether this lorry driver would again come back from Punjab to Visakhapatnam, to take the certificate or to ask him for a refund of 500 rupees. Practically not possible. And therefore, for transporters, if they furnish PAN to the consignee who is making payment, right, no tax was to be deducted. However, this provision has undergone a change. Now it is only small transport contractors. So only small transporters. Now small transporters would mean those covered by 44AE. Would again mean, those transporters who have got less than 10 or less than 10 goods vehicle. Only these transport contractors are subjected to no tax deduction. For rest of them, the tax deduction would happen at 1% or 2%, as the case may be. So if it is other than individual and HUF, rate would be 2%. If it is individuals and HUF, rate would be 1%. Now, how does this consignee here would know that this transporter is a small transporter? He doesn't have a way or method of finding out whether he's a small transporter or a large transporter. So these transporters would give a declaration. So he not only gives a declaration, right? He not only gives a declaration to the contractee, but he also gives along with the declaration his PAN. So once he quotes PAN and gives a declaration, the consignee is free. He would not be a deductor then. No deduction got to be made in respect of such transporter who furnishes declaration, and he also gives his own PAN to the consignee. Then the subcontractor in transport business, again, if the PAN is furnished, no deduction got to be made, similar to transport main contractor. Well, let's look at the threshold limit. As far as the threshold limit is concerned, well, here you have got a interesting threshold limit. In fact, you have got two of them. The first one is when, see here, the deductor is contractee and the deductor is, deductee is contractor. Right? From the payment made to the contractor, the contractee is going to deduct the amount of tax. Now, when is he going to deduct tax? So, if the total payment to the contractor exceeds 30,000, if it exceeds 30,000, in that case alone, deduction would happen. So, for small contracts where, the amount involved is small, no deduction got to be made. Up to 30,000 rupees, no deduction got to be made. Now, what the contractee would do? Contractee would actually, break up his payments. Contractee would, break up his payment into an installment of 30,000, lesser than 30,000. He would always make payment of 28,000, 29,000, right? But not 30,000, so that he escapes the deduction of tax at source. Therefore, what is stated again further, the second limit comes into play. It says that one time you not to exceed 30,000. So for every payment, don't exceed 30,000. Or, in aggregate during the year, you're not to exceed 1 lakh. So if you exceed 1 lakh rupees, right? So if you make payment of 28,000, 29,000, and 27,000, you're not exceeding 1 lakh until this. It's fine. But the next payment, let's assume, you make a payment of 25,000. Now here you would exceed 1 lakh. So you have got two limits. Every transaction should not exceed 30,000, right? In aggregate during the year, it should be lesser than 1 lakh. If it exceeds 1 lakh, in that case, you will have to deduct tax on the entire amount, right? So 25,000 paid, 4 times. You don't exceed 1 lakh. Since you do not exceed 1 lakh, no deduction got to be made. The moment you make the next payment, let's assume, you make a fifth installment of 25,000. You'll have to deduct tax on entire 1,25,000 at the rate of 1%. So you end up, deducting 1250 out of this 25,000 which you paid in the fifth instance. We get this. So you have got two kinds of limits, the 30,000 rupees and 1 lakh rupees. So it should not exceed 30,000 rupees in single payment or 1 lakh rupees in aggregate during the financial year. You look at this, you've got illustration 2 here. So you've got 20,000. See, X is a contractor. He makes a contract of works and makes a payment of 20,000, 25,000 and 28,000. So all three of them are below 30,000. No deduction got to be made. On 1st of March, again he pays 30,000 only. So it does not exceed 30,000. So never has he, triggered the limit of a transaction of payment exceeding 30,000. But yet in aggregate, he exceeds 1 lakh. So the total payment is 1,03,000 during the previous year, and since it is 1,03,000, 1030 got to be deducted on the entire amount. Do you get it? Now contract. Let's come to the very essence here, and it is what amounts to a contract. What amounts to a contract? See, everything we do is a contract. So it could be contract of sale. We have learned it in the Sale of Goods Act, the contract of sales. Right? It could be any transaction that you undertake. At the end of it, it becomes a contract. But what are the contracts covered here? So whether you go to a D-Mart or a Big Bazaar, and buy goods worth rupees, let's say 40,000 rupees, whether you should be deducting tax at the rate of 2% out of the payments that you make to them. Because ultimately, D-Mart would be a contractor and you would be a contractee. In a sense, there is a contract between both of you. Now, whether you will deduct 2%, if you deduct 2%, what the D-Mart guy is going to tell you, he is going to ask you to just keep the material and get out of the store. The reason why it is like that is because here it is only contracts which are covered by the definition of works, right? So works include advertisement, broadcasting and telecasting, including production of program such as broadcasting or telecasting, carriage of goods or passenger by any mode of transport other than railways. So for railways, you're not going to deduct tax. Catering services, whenever you are engaging a caterer, the amount that you pay would be contractor. And manufacturing or supplying a product according to the requirement and specification of the customer by using material purchased from such customer, right? So you are a job worker, right? You are a job worker. In this case only you are a contractor. So therefore the definition of contractor here is quite small than the definition that we understand in the normal legal language. So contractor here would only include an advertisement contract, a broadcasting or telecasting contract, carriage of goods and passengers, catering, and manufacturing or supplying a product according to the specification of customer. So it is not all manufacturing and supplying of product. Not all the sales are covered. Only sales which are in accordance with specification of customer, tailor made to suit your requirement from the material that you have supplied. Only in that case, it becomes a works here for the purposes of section 194C and not all of it. So construction services again would be covered by the definition of works. You would be a contractor, building a dam. He is a contractor, would be subjected to 194C. Then, so it is an inclusive definition, but it specifically excludes sale of goods on an independent basis. What I mean here is, not all of the items of contract is covered. Some of them have been excluded. One of them is sale of goods, right? Sale of goods, if it is not in accordance with the specification of the buyer from the material purchased from the buyer himself, in that case, no TDS would apply under section 194C. Then further non-applicability of TDS, no deduction is required to be made from sum likely credited or paid if the contractor is into the business of plying, hiring or leasing. If he furnishes PAN and gives a declaration that he owns less than 10 or less trucks, goods carriages, not trucks, goods carriages during the year, and he is engaged in plying, hiring and leasing of the vehicle, and he also gives his PAN. So that is a specific exemption granted. Now the question is whether professional services rendered by lawyers, physicians, surgeon, engineers, accountant, whether they would be works, whether they are contractors. The answer is yes, they are indeed contractor in normal sense. But then when it comes down to deduction of tax, they are governed by a separate section called as 194J. We are governed by 194J in such cases where the contract is with professional and not 194C. Separate provision for professional fees is done under section 194J. We'll come to it. Take up some problem if there are any. So therefore, let us check who is the deductor, who is the deductee, and what is the threshold limit. By the time I take up some problem, yes, Mansha says HEC is applicable to 194, 192, 192A, yes. As far as 194B, I'm not sure. I'll just check whether 194BB is covered by it. Not sure. I remember that there is some mismatch in 194B and BB as far as higher HEC is concerned. The health and education says. I'll just check, Mansha, and I'll let you know. You're right. Then it changes the entire dynamics. Let me check 194B and BB again. I'll just check whether HEC is applicable. But for rest of it, you're right. Income of 5 lakhs is greater than income of lakhs 2. Karan, I feel this is in respect of salaries. Is your question related to salary? Please confirm. Series of payment in the year. Just tell me who's the deductor, deductee, and what is the threshold limit and what is the rate of deduction. 5,000. It is, see, Mansha has given a very complicated question, and the complicated is not with reference to the, the legal point involved, but it is, it covers a lot of simultaneous payments where there is a higher deduction, done by the deductor out of the deductee. That higher amount got to be deposited. Next payments are also subjected to TDS even though the previous higher deduction was made. See, the previous higher deduction is not going to govern the subsequent payments. You're not going to adjust the previous higher deduction into the subsequent payment. It is, similar to the indirect taxes that you have seen, wherein if you collect more, you'll have to deposit it. There is no question of either you enriching yourself because of the higher deduction, or you're passing on the benefit to the deductee into the subsequent payment. You'll get a credit of it anyways. Yes, if you refund it back to him, that's fine. Then you got to only deposit that much which you have deducted. Right, so who's the deductor here? It is the contractee, because it is the contractee who makes the payment, right? So payer or the contractee would be the deductor here. He makes the payment to the contractor for works undertaken, right? So it is in respect of works which the contractor is doing. Sale of goods specifically excluded. Transporters, small transporters specifically excluded, right? Here, whatever you pay with reference to the contract. It is not necessary that it should be a written contract only. It could be any contract. The rate is 1% in case of contractor being an individual or HUF, right? 2% in all other cases, right? So if the contractor is an individual, he ends up paying 1%. If he's a corporate, right, in that case the contractor would have to deduct 2%, right? Let's move ahead now, therefore. Insurance Commission, Section 194D. It casts responsibility on any person responsible for paying to a resident any income by way of remuneration or reward, right? So who's going to pay commission, insurance commission? It is the insurance company. So who is the deductor here? It is the insurance company. Right now, on what should you deduct? You should deduct it on remuneration or reward, whether by you call it as commission or you call it anything. Whatever you call, you have to deduct it on remuneration and reward, whether by way of commission or otherwise, for soliciting or procuring insurance business. No, insurance agents, they don't like themselves to be called as agents nowadays. So they give all the fancy names. They'll call themselves as advisors, or anything else, but not agents. And therefore the commission that is paid to them is also given fancy name, like advisory, fees or anything else. So whatever the insurance company is paying towards to an insurance agent, basically, first by whatever name called, for soliciting or procuring insurance business, would be tax deductible under Section 194D. Who's the deductor? It is the insurance company. What is the rate of deduction? It is 5% of the commission paid by such insurance company, right, to the agent or the insurance advisor at the rate of 5%. If such commission exceeds 15,000, right? So the threshold is 15,000 rupees of commission. If the commission exceeds 15,000, where the payment is made by insurance company for soliciting or procuring insurance business, the rate of deduction would be 5% out of the amount paid to the agent, right? So the time of deduction would again here be either the credit or at the time of making actual payment. Yes. So do you get it? 194D. There's nothing much to be explained there. I hope you understand it. 194D, quite simple. It covers deductor. The deductor is the insurance company. And the deductee is the agent of the insurance company who procures, who solicits payment of insurance commission, insurance premium, right? So he gets, generally as a percentage of premium, this agent is paid by the insurance company a commission. Commission paid in excess of 15,000, exceeding 15,000. So up to 15,000, no deduction. Beyond 15,000, you'll have to deduct at the rate of 5%. 5% under section 194D. Then let's move on to the next section, and that is payment in respect of life insurance policy. Now, life insurance policy, any maturity proceeds of life insurance policy is exempt under section 1010D. Well, have gone through it multiple times. 1010D, we have dealt with it while we discussed 80D also, right? Mediclaim policy, or we discussed section 80C. Under section 80C, we have discussed 1010D, sorry. Taxability of sum received under life insurance policy. It is covered by 1010D, and usually anything that you receive is exempt from tax. However, there are certain policies which are outside the ambit of section 1010D. Anything that you receive on a policy which is outside the ambit of 1010D, it would become taxable. Since, it was becoming taxable, but a lot of the payees were thinking that it is not taxable and they were not paying tax. And therefore, this was a recent addition done by the government, where what they said, whenever the insurance company is paying any amount on an insurance policy, whether by way of bonus, or refund of premium, or the maturity proceeds, anything that you pay, and if it is taxable in the hands of the insured, so if it is taxable in the hand of the insured, so when it would become taxable in the hands of insured, when it is not covered by section 1010D. Now, when a policy would not be covered under section 1010D is when, in respect of policy issued prior to 1/4/2012. So prior to 1/4/2012 or up to 31st of March 12, if you are paying more than 20% of the capital sum assured, if you are paying more than 20% of the capital sum assured for policies which are issued after, from 1/4/2012, from 1/4/2012, this rate of 20% has been brought down to 10%. In case of, we've seen in case of disabled dependent, or, those who are covered by those deadly diseases provided in 80DDB, this rate is 15% from 1/4/2013. We've discussed this. There is one such year wherein the rate is 10% for all the assessees. So if the premium exceeds any other limit, it would not be governed by 1010D. So basically, a policy which has got investment motive, that is not to be exempted, and therefore you have got these limits of maximum premium to be paid. So if the policy is taxable, in that case, any such policy would be subjected to a rate of TDS at the rate of 1%, right, to be made by the life insurance company, right? So it is the life insurance company, when it is making payment to the insured, right, at the time of making payment, would deduct tax at the rate of 1% under section 194DA. Now, this deduction would be made only if it exceeds a threshold. Only if it exceeds the threshold of 1 lakh rupees or more. Now, understand, this section is important from your examination perspective, because it has got an amendment with effect from 1/9/2019. From 1st of September 2019, the rate of 1% has been increased to 5%, right? 5% of the amount that is paid by the insurance company to the insured. However, in any case, If the amount is below 1 lakh, if the amount paid by the insurance company is below 1 lakh, no deduction is required to be made. So a higher threshold is given. Now 1 lakh or more, you'll have to deduct at the rate of 5%. If the policy has matured after 1st of September 2019, if the policy has matured prior to that and the payment has been made by the company prior to that, in that case, it is 1%. The rate is going to be 1%. Let's check who's the deductor here, who's the deductor, who's the deductee, right? And the rate of TDS. Malvika, your question is, please explain the term completed year of usage. Can you tell me for which section are you asking this question? So deductor is the insurance company. Deductee is the insured, right? Amount exceeding 1 lakh or more. So it covers 1 lakh also. So exceeding 1 lakh 1, right? Under a policy not governed by, not taken care of by 10D, the rate is 1% or 5%. Right, 1% in case if the policy payment is made prior to 1st of September 2019. If the policy is paid after this date, so after 1/9 on or after 1/9/2019, 5%. Right? Do you get this? Important. Now again here, deduction is to be made at the time of actual payment. It is the payment which governs deduction under 194DA and not the credit to the insured account. It is not the credit at the time of credit or payment, whichever is earlier. It is here, it is at the time of making payment. Then let's check up payment to a non-resident sportsman or sports association under section 194E. Now somehow it is there in the module. Let's take it up. Non-residents, sportsman or sports association. What happens is when you have got a joint sport competition, the Australian Cricket Board and the BCCI coming together for a series. Now the revenues are shared. Right, so when payment is made to a non-resident sportsman or a sports association, deduction of tax would have to be made at the rate of 20.8%, including HEC. Right, so any payment that you make to such non-resident sports person or an entertainer, right? So it could be an entertainer who has come to perform in India. Let's assume Justin Bieber. So he comes and he performs, entertains the crowd, takes away money. The person making payment to such entertainer or a non-resident sports person, he'll have to deduct tax at the rate of 20%, and along with that he also collects the HEC, the health and the education cess, at the rate of 4%. So the total rate of deduction would be 20.8%, which is similar to 115BBA. Right, so it covers everything. The deductee here would be that non-resident sports person or a sports association. NR Well, remember it also includes the amount received on advertisements. So it would also cover advertisement that a non-resident sportsman is making in India. So you see in IPL, while the IPL is going on, a lot of foreign sportsmen would come in India and they advertise for a particular product. Anything that they receive out of that advertisement contract, would be governed by this section here, 115 BBA. Right. So when you talk of the deductor, it's the organizer. Deductor would be an organizer here, paying to a non-resident NR sportsman or a sports association. So revenue sharing by a sports association, which is foreign sports association. And there is no limit, no threshold here. There is no threshold. The rate of deduction is 20.8%. So it includes education cess. Again, this is at the time of credit or payment, whichever is earlier, right? Whichever is earlier. Let's move on to next. Yes, Aditi is asking a question. So if the amount of premium exceeds 1 lakh, under which head it would be recorded? Well, it depends. If you could take it under capital gain or income from other sources. It depends on the intention that you had. Let's move to 194EE, payment in respect of deposit under National Savings Scheme, etc., NSS. So, and if at all you are being paid interest on NSS, rate of deduction would be 10% if such payment exceeds 2,500. So nothing much to be explained there. Under a scheme, if you are being paid more than 2,500, any payment would attract a deduction of 10%. It's a saving scheme of the government. So interest is generally paid and it is after deduction of 10% of TDS. Repurchase of units of mutual fund or unit trust of India. 80CCB2, this particular, repurchase scheme is now not in, it's not in place nowadays. It was well prior to, 1991-92 when it was in place, 80CCB. So I don't think it is so relevant now. But if at all it is done, if at all there is a repurchase of unit today, there would be a 20% of deduction under section 194F. Looks not much of a relevance. Let's check this. Commission, etc. on sale of lottery tickets. Now, lottery tickets, the people who sell lotteries either get commission. If they get commission, in that case, a rate of 5% is prescribed. Now, when you look at commission, you have already seen a couple of sections earlier. You've seen 194D, 194 H we've not gone to. Okay, we'll go to H, and 194G is now what we get here. So commission by a lottery agent would be again subjected to 5%. If you remember, insurance agent, it was 5%. For lottery agent also it is 5%. For all other commission under 194H, which we are going to discuss now, it is 5%. So amount exceeding 15,000, here also the amount was exceeding 50,000, so it is all rationalized. All of them have got the same set of limits, right? So if the amount exceeds 15,000, then you got to deduct tax at the rate of 5%, right? In case of a person who is earning commission remuneration by whatever name called from sale of lotteries. right? So if facilitates the sale of lottery, gets a commission, tax is to be deducted at the rate of 5% at the time of credit or payment, whichever is earlier. Now, what happens to just circumvent this 5% of a TDS? What people do is the lottery agents, they purchase lotteries. They purchase lottery and thereafter they sell it. Now, if it is a contract of purchase and sale, it is not governed by 194G. It would be outside the ambit of section 194G of the Act. Let's move to the next provision, 194H. Again, widely used section 194H. All other commission, other than, the insurance commission or the commission, covered by 194G above, commission on lottery sales, all other commission would go under the head of 194H. Any person other than individual or HUF paying any income by way of commission other than insurance commission shall deduct income tax at the rate of 5%. So either it is brokerage commission, anything, it could be with reference to a dealing of a fixed asset, right? Generally, when you buy or sell a house, when you take something on rentals, there would be an agent, and that agent is paid commission. That commission would be subjected to a 5% rate of TDS, and it is to be deducted by any person other than. So you have got an other than individual and HUF, but only the small individuals and HUF and not the larger ones. So larger ones means those who exceed the monetary limit of 1 crore and 50 lakh specified under section 44AB. If you are a large individual and HUF, you have to deduct tax at the rate of 5% on any commission brokerage that you pay to any resident, right? Any resident. The time of deduction would be either time of credit or actual payment, whichever is earlier. So it is not just the payment. See here the logic again, you understand the logic why credit or payment, whichever is earlier, is given. The reason is because this commission is going to be claimed as expenditure. Expense by the principal, right? If the principal is using the services of an agent for his business, he'll claim the amount of commission paid or payable to him, right, as expenditure of business. Now, what does he do? He calculates the amount of commission, debits it to the commission account. Commission account debit to commission payable. Commission account debit to commission payable. Now, when he does this, what he indeed does is he would not pay tax on the amount of commission because he'll claim deduction of it. Now, if he doesn't deduct tax, even the agent may not pay tax, end up paying tax, and therefore, what is provided is you must deduct tax at the time of credit or payment, whichever is earlier. By whatever name called, you can call it as commission payable account, or you credit it to the real person, right? You credit it to XYZ, right? Anything, any credit given for commission, if it precedes the payment, actual payment, you'll have to deduct tax. Sometimes commission is paid in advance. Now, when commission is paid in advance, credit is happening afterwards. It is on payment basis. So payment or credit, whichever is earlier. No deduction, threshold limit of 15,000 is provided. Meaning of commission and brokerage is provided. As we understand it, it is almost similar. There is no change there. Non-applicability, commission is not applicable for professional services. Services which are professional in nature, would not be governed by 194H. Very, very logical, nothing to be explained. It is so, pervasive. This section is widely used, but again, very simple to understand because whenever you are paying commission, you know that you are paying commission. And once you're paying commission as a deductor or as a principal, As a principle, you'll have to deduct tax from the payment made to agent in the nature of commission or brokerage at the rate of, sorry, it was 10% earlier, now it is 5%. 5% on commission exceeding rupees 15,000. Right, do you get it? So all assessees are covered by this particular 194H, excluding individuals and HUF. But the individuals and HUF were governed by 44AB. A and B would be still covered. Let's move on to the next one. Again, very prevalent, widely used, section 194I. Any person other than individual and HUF again, but not the large individuals and HUF, they have been brought into the tax ambit, who is responsible for making payment to a resident by way of rent. You're making payment of rent. Rent is generally paid for use of a asset, right? It could be movable asset, it could be immovable asset. If you are taking control over an asset and you are making some payment of rent or higher charges, any, for that matter, whatever name called, you will have to deduct income tax at the rate of 2% or 10%. Now, when does 2% come into play? 2% would come into play if rent is paid for plant, machinery or equipment. Right? Only 3 items: plant, machinery or equipment. In all other cases, it would be 10%. In respect of other rentals, rent for use of land, building, including factory building, land appurtenant thereto, or furniture or fixture, the rate is 10%. Only for plant, machinery and equipment, the rate is 2%. Now, plant, machinery and equipment is what you understand. Generally, while you look at, the depreciation schedule, you'll know what plant, machinery or equipment is. So, when it is higher of movable property being plant, machinery or equipment, the rate is 2%. When it is immovable property, usually land, building, factory building, or land, appurtenant land, or furniture or fixture. Furniture or fixture is covered by 10% rate. Why it is so covered, I'll just explain in a short while. However, individuals and HUF, smaller, not covered, but larger individuals and HUF who are covered by 44AB, A and B would be subjected to tax. When do you need to deduct tax? When you credit or make a payment. I told you credit or payment, whichever is earlier. The logic is quite simple. The deductor is going to claim expenditure of the rent. Therefore, credit or payment, whichever is earlier. Threshold limit. There is a threshold limit if only the rent exceeds 2,40,000. When the rent exceeds 2,40,000, only then would you deduct tax at source in a financial year from the payment that you make to the owner. Right? Here it would be lessee and the lessor. So one who is the lessor, you will have to deduct it only if the payment exceeds 2,40,000. Rent means by whatever name called, lease, sublease, tenancy, for use of. It is important here, it is the use of land, building, land appurtenant thereto, machinery, plant, equipment, machinery, plant and equipment, furniture or fittings. Now this is covered by 2%. Rest of it covered by 10%. Rent is defined. Rent means, right? So rent only means anything that you make payment for use of land, building, machinery, plant, equipment, furniture, fitting. Any other rent would not be covered by this section. Now, one of the very interesting disputes was with reference to the storage charges recovered by the cold storage owner. Whether the storage charges would be subjected to section 194I or whether it is subjected to 194C. The storage charges, they may call it as rent. While the cold storage owner keeps certain goods in his compound, he may call it as rent, or he may call it as charges. But then whether this charges or rent, whichever is paid by, whatever is paid by, the person who's keeping his goods into the cold storage, whether it would be governed by 194I. The answer is no. The reason is because the person keeping goods in his premises do not get access to the premises, do not get the right to use the premises. What is he using? He is using only the facility for storage of goods. Now, it does not mean that he becomes the, it does not give him the right to use any demarcated space or place. It only gives him the right to keep his goods in a particular condition. And therefore, board came out with a circular that the essence of the agreement is not to let out the place, but it is to keep the goods in a proper storage condition. It is not right to use any demarcated place, and therefore it is not use of land as such. Use of land is only incidental. What is it all about? It is about the storage of goods in the right condition, to be governed by 194C and not 194I. So cold storage owner is not a lesser, but he is a contractor for storage of goods in a right manner. So let's move ahead. That is 194I for you. So any tenant, see who's the deductor here? Who's the deductor? The deductor is the tenant. Who's the deductee? He's the landlord or owner. Owner of a movable asset, being plant, machinery, furniture, fittings. Now, when does he require to pay tax, deduct tax? When the deductor would be required to deduct tax? Only if the rent exceeds 2,40,000. The rent is subjected to 10% or 2%. Right? 10% in case if it is any immobile property, furniture or fitting, or 2% in case if it is plant, machinery or equipment. The 2% rate is just prescribed because plant and machinery would be subjected to the depreciation. You get some additional expenditure, right? And therefore 2% is prescribed on machinery, plant and equipment. Alright friends, we end for today. We continue with rest of the sections tomorrow. I am sure we'll be able to complete this chapter tomorrow in its entirety. Tomorrow is going to be the last lecture. We take up advanced tax, provisions relating to advanced tax, interest, TCS, and a few sections that we have in respect of TDS. So thank you so much for being with me. We continue tomorrow.